In my last video, I talked about covered calls and how it can provide a steady stream of income while holding the underlying stock. In a bear market, it can provide some form of relief if done correctly and consistently. It will bring down your cost basis to some extent. But can this work for leveraged ETFs? Let's try and answer this question. Hey leverage ETF fans, welcome to the channel. My name is Raj, and on this channel I share investment ideas and ways to manage money and build long-term wealth. I recently did a video on covered calls. If you don't understand covered calls, I strongly recommend you watch that video first and then come back to this one. At the end of the video, I teased about using covered calls with your existing leveraged ETF position. In this video, I want to go deeper on this topic. If you don't know what leveraged ETFs are, or have never invested or traded, or are a new investor, or really plan on keeping your money safe in the short term, please do not jump into leveraged ETFs. It can completely destroy your portfolio if not done right. I have a whole playlist on this topic if you want to learn more about it. I'm a huge fan of leveraged ETFs and constantly looking for ways to better manage this product. I think you should strongly consider covered calls if you're doing leveraged ETFs. For the last couple of months, I've been messing around with this. Let's jump on my laptop and make some sense out of this. Alright, so I'm gonna get on to Fidelity, share some screens, some data, show you what I mean, right? So here is the options chain for TQQQ. Right now, if you remember from my last video, the two big things is delta and implied volatility. With leverage ETFs, you don't have to worry about some of these things, and I'll explain why. Let's look at the options change for 28 days out. Look at the implied vol. It's in the 90s. 80s, 90s, right? What does this mean? Well, if you remember the video, higher the implied volatility, higher the premium that you can expect, right? Now, let's for comparison's sake look at Apple, and I have it open in this other screen again. The implied vol, it's in the 30s. Not bad, but you're gonna get less premium just because the vol is low. So the biggest reason to do covered calls on your existing positions on leveraged ETFs is this volatility, the implied vol. And there's a reason why this is high, because it fluctuates so bad that it's impossible to figure out what the move is going to look like. So if you were to ask me, hey, what is it going to look like in 1 month? 50%, 40%, 100%? I don't know. But I do know that implied vol is high. And if I can figure that out in terms of how much it can move, I can take advantage of this high implied volatility by selling covered calls. So I did a little bit more digging, because nerd that I am. If you look at the weeklies, right, the implied volatility gets even more juicier and crazy, right? It might be difficult to figure out how much these guys move on a monthly basis, and I've run data on that, but it's a little bit more easier, well, not easier, but a little bit more manageable in weeklies. Now, this is 7 days out, right? I'm recording this video on a Friday, and typically I want to open a new covered call, write a new covered call on Monday morning on my existing positions. The question now becomes, what is a good strike price, right? So right now it's trading at around 24. How much out of money call you should write so that you can get a beast of a premium, right? Again, we are here for the premium. So I did some more digging, right? I went to historical information to figure out the weekly move for TQQ, and it's for last 5 years, which is 260 weeks. That's a decent sample size and a decent period, because in this period we had recessions, we had the COVID, we had raging bull market, we had all sorts of things, right? And then I sorted it by percentage change, right? With high being, with the highest on top. 20 times it has gone over 12%, and that's the column F, right? If you saw this with high to low, 20 times it has gone above 12%, which is, in terms of probability, it's 7.7%. So if you were writing covered calls for like 12% out, let's say it's 24, 12% out, whatever that number is, 26, or I don't know, whatever that number is, chances of that breaching $26 is around 7.7%. If you sell it or write covered calls 13% out, your chance is 6%, meaning it will go over 13%, 6% of the time. And in that case, you will have to sell it at whatever price it is. So let's say you wrote a covered call for 27. Based on some of these numbers, if it goes beyond and it ends up at 27.5, you will be forced to sell your position at $27. 14 times, it has gone over 14%. Probability of that happening, 5.3%. Probability of going over 15%, 4.23%. So this gives you a general idea of where TQQ flirts. And it's a high probability trade, meaning 96% of the times you will end up keeping your stock on TQQ plus any any premium that you receive for that week. I think those are nice odds. Again, this is 5-year information for the last 5 years. Next 5 years could be something else. I don't know, but this is the best I've got at this point, right? So if you put that in a model, what does that look like, right? I mean, assuming, it is at 2407. These are the percentages, these are the probabilities, and these are the corresponding out-of-money calls that you can potentially write to seek or get some premium. So let's put this into action, right? So let's say you like the odds of somewhere around 13-14%, right? 14%, let's just say 14%, right? Which means, and I've already kind of built a model around this, which means you should, or at least write a call somewhere around 27.50, right? So if you go back to the option chain, 27.50 is right here, and the premium you can expect is around 33 cents. Reduce the size so that I can get the calculator. Okay. Let's assume that you have 500 shares of TQQ, right? And which means you can get 5 contracts. Now the premium that you can expect is 33 cents for 27.5. So that is 500 times 0.33, because that's a premium you can expect per share. You can expect around $137 in premium, right? Now 500 times 2407 is somewhere around $12,000 you've invested in, that's the money, that's what it's worth today. So if you take 165 and try to figure out the percentage for that week that you made by just writing covered calls, it is 1.37%. That is just by writing calls, right? Now, assuming you did not, like TQQQ did not breach 2750, in that case, you will keep your 500 shares, plus you get to keep your $165 and repeat this the next week. And you can keep doing this, right, until you get assigned where you have to sell it. In that case, it's not a bad sell because you sold TQQ at a 14% premium for the week. You can always rebuy it, and you could do other things like cash secured puts, which I think it's a video for some other time, but you can always rebuy it. Now, what does this mean? Yeah, you might say, $165 on 12,000. Yeah, whatever. It's not a hell lot. Let's put this a little bit in perspective, right? If you did this every week, right? And I'm just assuming TQQQ goes nowhere. Let's assume this stays put, like your $12,000 stays 12,000, and you continue doing this every week. 165 times 52, you can make $8,500 just by writing calls every week on your $12,000 invested. Now, if you were to compound this on a week-by-week basis, and I'm assuming this goes nowhere, which is a huge assumption, which never happens, but just for the purpose of this video, I'm going to assume that this stays put. It stays at 24 all the time. If I were to compound this, right, my initial investment is 12,000 of 35, and I make around 1.37%, and I did this every week, right? And I did this for 1 year for 52 weeks. That's my compounding because I'm going to reuse 165 in. And you calculate, that's a lot of premium earned. Now, even if, things go south and you get assigned and, you couldn't do things, even if this is half, even if it is like $5,000, right? Even if this number is, instead of 100, is like 40 or 50, that's a massive return on something which you already own. It's a no-brainer. I think if you're using leveraged ETF as a long-term investment tool with these kind of implied volatility, I think you have to write covered calls. Now, your comfort level can be different. You might just say, what, I just want to do 15% or maybe 16%, right? Just put 16% because that's your comfort level, right? So 16% is what, 27, let's say $28. Let's just see what kind of premium you can get for $28. Remember, this is 16% higher than $24. So you would write a call at $28 strike, right? And the premium we would expect is 26 cents. Again, 500 times 0.28, $140. Into perspective, divide by 12,035. That's like 1.16%, right? Drop that into your model, 1.16. That's still a lot of good return on something that I intend to hold for a while. Bottom line, you have to do covered calls if you're holding TQQQ for the longer term. Back to my video. Wow, that was long. That is usually not my style. But I think at times it is important to make things real to get the point out there. Few other things to note. In my opinion, this works best for liquid ETFs like TQQQ and SOXL. I'm not seeing enough open interest for UPRO or TECL. You will need to consider taxes. Premium collected is considered short-term gains. Also, if you go in and out quite frequently, you will be hit by the wash sale rule. Look it up. In my third week, I got assigned. Yes, there are strategies to avoid that, but I was looking to get assigned. I wanted to not stay in leveraged ETF if I could for the month of September and October. Seasonally, not the best times for equities. This is turning out to be a smart move. With that said, I'm still earning a premium via cash secured puts on leveraged ETFs. It's a video for some other time. Here's a quick summary on puts. Think about cash secured puts the inverse of covered calls. Let's say TQQQ is at 24. With covered calls, you can make a bet that if the price hits 27, I will sell my position. With secured puts, you're betting the other way. If TQQQ hits 22, I'm ready to buy. But remember, to do this, you need to hold enough cash in your brokerage account. Here's the fun part. For both strategies, you are earning a premium and you are either selling at a higher price or buying at a discount, assuming you get assigned. If you don't, your position or cash is intact and you just made some extra cash via premium. As we get closer to November, I will get back into leveraged ETFs and continue writing covered calls. Of course, I'll do this via puts and use an aggressive strike price to get the most premium. Look up wheel strategy. It combines these two strategies, and since you keep alternating between covered calls and secured puts, it's called the wheel. I'm working on my own version of the wheel. It will be on steroids since we are talking about leveraged ETFs, weekly options, and some crazy volatility. You got a teaser of what it might look like in this video, but I will do a video in future once I feel that I have it refined, tested, and is working, and maybe share some results. So stay tuned for that. That's all I have, guys. Really curious to know if you are using this strategy and how is this working out for you. Thanks for watching. Until next time, peace.